Hi everybody, it's Alan Henderson from Erskine and Owen and Lisa Phillips. We're both directors of Erskine and Owen, I'm just gonna sort of chat away for a couple of seconds while everybody's admitted to Zoom. So I'm just watching the attendees, and we know how many people are attending. So we'll just chat away, and I'll give you some background. So
Hi everyone.
this is Lisa Phillips and Alan Henderson. So we're both broadcasting from home. It's 7 o'clock in New Zealand, and so that's why we're broadcasting from home. And I understand it's 8 o'clock in the morning there. So well done for everybody that's managed to get up and get themselves in front of a computer screen this morning to hear about the New Zealand property market. So just briefly, just a little bit of background about who we are. So I'm one of the directors. From about 2011, I used to come up to London and present. So there may even be some people that were used to seeing me, and I'd come up and present on the New Zealand property market. And I think the first year that I did it, we had about 180 people in the room, and I was just really stoked that so many people wanted to come and hear me speak. And then, but I quickly realised that it actually wasn't to hear me; it was for the New Zealand beers and the mince pies. So I kind of figured out that was the reason why most people came, and then just to get their cans hours up and get their CPD sorted for the year. So it was kind of I got that, but that was all right anyway. And with COVID and it's just obviously travel's not so possible, and so we're doing this over Zoom. So so Lisa Phillips is co-director, and I guess Lisa Phillips is probably more the brains trust and does a lot of the research in the background, foster keen around where the market's going. And so the format for tonight is that I'm going to be interviewing Lisa. They're mostly me interviewing Lisa. I'll probably comment on the banking side of things, and we'll go from there. So the New Zealand property market, where are prices headed? Where should you buy? What should you buy? What are the banks doing? What's the Reserve Bank doing? Should you buy it all at the moment? Should you sell? So we're going to cover off those questions. But I think it's probably useful, first of all, to understand where we've come from and how we've arrived at where we are today with COVID in terms of the property market. And so, Lisa, the first thing is that first question: where have we come from? What's happened to bring us to today, where we are in the property market, and what are some of the things that we should be thinking about in terms of where we've come from?
Yeah, just it's been kind of interesting time, and it feels like a lot's happened in a short space of time. So I guess just to kind of paint the picture and give everybody sort of the timeline to give some context to we were in full lockdown for pretty much the month of April. So now we've been out of lockdown for pretty much 8 weeks. So it's been kind of an interesting time for the property market. And I guess we need to sort of understand what was happening to the property market before we went into lockdown, because that's kind of been really relevant. We've done really well coming out of this, but what was going on before we went into lockdown was that the market was just continuing to build from the end of last year, and then sort of COVID hit. We went into lockdown. That all happened in sort of short time frame, and then what sort of happened in the sort of month following, obviously not a lot of activities during that month of April, but then we kind of rebounded really, really well, and everybody kind of picked up, and it was sort of like business as usual. So it's been, I think it's been fascinating that the property market has kind of picked up to sort of where it's at. So I think just to kind of stop and go, well, where are we? What has happened? What do our stats look like? So looking at the house price index. So for those of you who are kind of used to sort of looking at median house price and understanding price growth in that way, we use a house price index here, which sort of strips out some of the anomalies and just gives a little bit of a more of a real view to what's happening with price growth. So where we're at as a country is that we've kind of built 8% on May of last year. So if we have a look at our May stats, we're kind of up 8% on May of last last year. What was happening in May last year? Actually, the market was pretty solid. It wasn't guns blazing, but it was doing pretty well. So to be up 8% after everything that we've gone through, that's pretty good. And then we say, okay, well, what's been happening in all the individual areas? So most of the regions are also up a similar amount, and we have a small handful that haven't. They're on a decrease, and that's kind of what we would expect. We would expect some of that that volatility. So, and then in terms of looking at what happened from the month of April through to the month of May, obviously there was, we had lockdown in there. So, coming out of lockdown, we've pretty much had minimal change to what was happening during April. Bearing in mind that this market was really active during lockdown. It was quite fascinating. People were still doing transactions. They were still going unconditional on deals. There was online auctions, and people were just continuing to do what they had started to do prior to lockdown in terms of buying. So I guess the upshot of all of that is that there is really no fundamental change in the market to date. Sales volumes have gone down, so we're down 46%, so that's actually quite a lot. Part of that, and this is obviously looking at May, is due to that we were in a level 3 lockdown for the first couple of weeks of May, so people were still working at home. There wasn't a lot going on in terms of trading, so still pretty minimal. It was quite difficult to do any viewings, and in terms of progressing any property transactions, it was all a bit limited. So, and then the median days to sell, which is also another thing that we look at when we're sort of looking at, well, where is the market likely to be headed? It's sort of one of our indicators, that there's sort of an early indicator of what might be happening with the market. That has gone up, so it is taking a few more days for properties to sell. And then we also have inventory down, so that's all the stock levels that's down about 20% on May of last year. And is that kind of unusual? Not really. We've been running probably pretty tight on supply for a number of months, and of course we're coming into winter now, so supply levels always drop through winter for New Zealand, so that's probably not that unusual. The thing that we should note with that is that when supply is down relative to demand, that does go up. So that's kind of good for the property market.
Yeah. Okay. So, so in your view, would you have expected, I guess, more carnage by now in this market? Like, I was sitting there during COVID and thinking that I might get calls from sales agents with mortgagee sales or desperate sales, but I didn't really get any. Would you have expected us to see more, I guess, more pressured sales in this environment, or is it too early? Is that still to come?
Yeah, it's kind of interesting. I think a lot of the forecasting has been to see price drop more than it has. Now, let's bear in mind that this is still very early days, and yes, I think we need to acknowledge that the market has bounced back. But I think what's going to be more interesting is sort of what happens in the back end of this year. But I think what a lot of the forecasting and sort of form of view has come from what happened during the GFC, and I think we just need to remember that the GFC was quite a different gig. It was banking led. It was more related to the property market, and so this is quite different. So what we did see was a lot of mortgagee sales, a lot of distressed sales, but now we're in an environment where the New Zealand banks have been, they've been really supportive. There's been a government mandate on that support. There's been mortgagee holidays, there's been deferral of principal payments. So all of these things weren't there for the GFC, but all of these things obviously mitigate that sort of distressed selling. So and look, if it hasn't happened by now, could it still happen? Look, I think we're still going to see people that need to sell because their circumstances have changed, whether that is just, jobs or need to relocate for different employment, etc., etc. But I don't think we're going to see the urgency of selling that we saw during the GFC.
And like just revisit, help me out on that. So why not? I mean, the GFC was similar, I guess, in some respects, but why would we not? I mean, I think businesses have had the wage subsidy, which is starting to come to an end. So you could say that the economy's been artificially propped up for the last month or so. So with that wage subsidy sort of running out, is it that we're about to see more businesses fall over, and therefore the property market being impacted where businesses fall, and so those SMEs with businesses that are backed up by property are then forced to sell their properties? Is that a likelihood where we could start to see employees and business owners squeezed that end up selling property to release equity?
I think we will. I think there are some things still to come in terms of the second half of the year. So for those of you listening, we're on a wage subsidy program that started right at the beginning of lockdown. So it went for 12 weeks, which is coming up to completion now. And then some businesses are eligible for a second tranche of wage subsidy, which will go for another 8 weeks. And so what a lot of commentators are saying is, well, what is going to happen when those wage subsidies run out? Now, that sort of time frame for running out is around September. So that's definitely something that we need to look at, but we also need to understand, well, what is the number of people that are on that second tranche of wage subsidy. So it's roughly around 200,000, which in one sense sounds a lot. In percentage terms, it's not a whole lot. So look, that is that's one factor, and we need to bear that in mind. We're also going to have people coming off more mortgage deferrals, so that's going to happen. So those that were sort of given breaks with mortgage payments, they will come off somewhere between sort of September to November if they were sort of given a sort of a 4 to 6 month break. We've got winter in there now, so we're just sort of while we've had a really amazing autumn here, we went into lockdown with most incredible weather. We are now getting into some of that winter season, and that winter season in terms of people just generally don't go to market until the springtime. Then what we're going to have is also some slowing household income growth, which you would expect that'll either come through job loss or just come through people just, through the time of uncertainty, just wanting to sort of conserve spending. And then, of course, we've got a general election coming up in September. So there's a whole lot going on in terms of considerations. But then if we just go back to the upside, if you like, which is what I would suggest is what the near term looks like, and that is that we went into lockdown strong. We can't forget that. We've come out strong, and that is important. There is the wage subsidy there, and that has helped a huge amount of people. We've got the mortgage holidays. We have a whole lot of expat Kiwis returning, so that's our population growth, and talk about that a little bit later to how that might sort of translate in terms of one of the fundamentals with the property market. And then, of course, what we can't forget is that we've got the lowest interest rates that we've had on record. So put all those things together, they are going to keep the market in with some sort of resilience.
Yeah. Okay. So you started to touch on some of the supply and demand drivers. So the way that we think about the market and try to understand what's happening with the market, and Scott and I, from a framework point of view, is looking at the demand and supply drivers. So we've just sort of talked broadly overall, and what I'd like to do, Lisa, is start to work through the significant demand and supply drivers one by one and get your view on them. So it's pretty simple economics 101. If demand exceeds supply, then we're likely to see house prices go up. So if we can understand the demand and supply drivers, then that will help us make an informed view of where the market might be heading. And so we're not really into crystal ball gazing, we're into understanding the drivers and to help us understand what could happen and help individuals and clients make their own minds up. So let's start with the demand side of it. What we know is from analysing data is that a couple of the biggest demand drivers, the population growth is a key one. So one of the two key ones, and then supply of finance is another key one. But in terms of population growth, when population grows, we know from our analysis that that's a huge driver of sales volumes. and so that will drive up demand for properties. So at the moment, are we stuffed in terms of, colloquially speaking, are we stuffed in terms of demand because we haven't got the borders open and we haven't got new immigrants coming into the country to help drive up demand for property? Or is it just status quo? I don't know. What's your views on population growth?
Yeah, I think this is actually quite interesting, and I have been doing a bit of reading on it because a lot of people have, commentators have just written off the net migration. And actually, when you look at it, it shouldn't be discounted as a factor in influencing the property market in a good way, because if we have a look at what happened with net migration in the year to March, so that's just sort of just before we went into lockdown, we had record net migration, and so that's really important. So we had this big flow that pretty much all of the net migration for the last year to March happened in the 4 months between sort of December and March. We had this huge influx of people heading home, not COVID related. And then so that's important. And we had record net migration, so we had been in this period of huge rapid growth for New Zealand. Then what we would expect is that tap got turned off, that net migration just stopped. But actually that isn't the case. What has happened is the patterns have changed. So we've had a sort of a netting off of our non-citizen movement. So we've had, if you're a non-citizen or non-resident, you can't come in at the moment. But also a lot of those non-citizens that were here were not leaving. So that kind of netted off. So then what this has come down to is that we've had a lot of Kiwis returning home, and of course our Kiwis that are here were not leaving. So what this amounts to in terms of numbers is that our net migration, just with our Kiwis, and we don't focus on our Kiwis in terms of our net migration figures. We always think about it as foreigners coming in to the country, but actually our Kiwis make up a big chunk of our net migration ordinarily anyway. So what this gives us is that we can safely say that our net migration has come from record levels down to half of record levels for this next year going through to March 2021 will be above our long-term average. So just quick numbers on that was that we could safely say conservatively that we're going to have 35,000 in net migration in the 2021 year to March. Our long-term average sits in sort of the mid-20s. Now that is enough to continue to support the housing market.
Yeah, right.
And
okay,
it's likely that it'll carry us through. We've got government policy around other migration that obviously is yet to sort of play out in terms of what border opening and what government policy will happen around who can come in the next few months. Okay,
so if I'm thinking about sort of demand drivers on this side, and one of the big ones is net migration. So we're not, as I sort of said before, good old Kiwis, we're not stuffed in terms of net migration. We're actually still going to have some growth, i.e. growing demand for housing. So really important to understand that population growth translates pretty directly to growing demand for housing. And I realise that residential housing is only one part of the property market, but obviously that flows through to commercial property as well. Availability of finance, and I'm going to ask myself this question, but it's all very well and good to have people in the country that are demanding housing, but what if they can't get finance? And so where are we at with finance? Can people get a hold of it? So there's a few things that I'm going to answer that. So there's a few things that drive that. About 4 years ago, or approximately, the Reserve Bank wanted to put a lid on the property market. They were really concerned about how quickly it was going up, and so they introduced a minimum deposit ratio or loan to value ratio. So the banks historically could go as high as they want. They wouldn't necessarily do that, but they'd go 80%, maybe 90% in some circumstances. And they came in initially and said there's a sort of like a 60% LVR ratio and then 70%. And now during lockdown, they've actually lifted that back to 80% and said banks can go for it. They've basically removed all of those. However, it's all very well for the Reserve Bank to remove those ratios, but the banks themselves are saying, well, we don't really care what the Reserve Bank says we can do. we want to protect our balance sheet, and they've been very cautious at the moment. And it is a bank by bank and then within a bank, a case by case scenario. So, for example, the BNZ is still, their mandate or policy is that they won't lend more than 70% on investment properties, but then that will be on a case by case basis. So if they see something that they want to bank and it's just, they've got a strong balance sheet, they will go to 80%. So I guess it's positive that banks have now got that flexibility to be able to lend more. And what is also, I guess, freeing things up is these lower interest rates. So, you know, we've had no OCR change with the recent announcement, but I expect that probably at the next announcement, we'll probably get another 25 basis points drop. Could do, may not, but I suspect we probably will. And that won't all necessarily flow through to retail interest rates, but it will definitely help some kind of reduction and keep rates down for some time. So the things that drive finance or credit are the affordability. So with interest rates so low, it means that when banks are assessing affordability, it stacks up a whole lot easier. So that makes it easy to pass tests, and then banks have the ability to lend more. The counter to that is that all New Zealand major banks are owned by Australian banks, and so we're really beholden to what the Australian banks are doing. If they need to shore up their balance sheets, then they'll just tell New Zealand banks, or from Australian point of view, New Zealand branches, to step in line and start paying money back to the mothership, so to speak. So from a finance point of view, it's good. There's really good potential, but it's really on a case by case basis. I think for a lot of Kiwi expats, that's reasonably positive, because a lot of Kiwi expats are earning good money, and so they'll be attractive to the banks. So just to round that out now, on the demand side, we've got, we haven't got a negative, I don't think, from what Lisa was saying, a negative population growth scenario. And finance is not, they're not throwing money at people by any stretch of the imagination, but it's probably a little bit better than what it was 6 months ago, arguably. Okay, so that's the demand side. Look, there's other things that drive demand as well, but interest rates we've kind of touched on. Interest rates are low, so that encourages people to buy, but those are probably the main ones. If we shift to supply, so we know that there haven't been massive negative, a plethora of negative impacts on demand. So, yep, there could be some people that lose their businesses and lose their jobs, and therefore they can't buy, and in fact need to exit. That may happen. Not seeing huge signs of it at the moment. In terms of supply, if we shift across to the supply side, Lisa, what are we seeing in terms of supply? And that's a multi-pronged question, because obviously you've got supply of existing stock, you've got supply in terms of developers are getting consents and then building. But maybe we just start with supply of property at the moment in terms of existing stock.
Yeah, so like I sort of mentioned earlier, we have stock levels are down on this time last year if we just sort of use that as a comparison.
Yeah.
But I think I would like to sort of think about our supply levels a little bit more broadly, because supply levels are a big fundamental and a driver of what the property market will do. Once you have an oversupply, whether it be locally or over a large area, that just puts downward pressure on pricing unless you've got the demand to service that. If we go back to the GFC, there was and look at what happened with the property markets in a lot of other countries, the direct correlation was to oversupply. And why New Zealand recovered really nicely from the GFC comparatively was that we didn't have an oversupply then, and we don't have an oversupply now. And I think that is really critical to understand that as a fundamental, we do not have an oversupply. We have long been plagued, particularly in Auckland, to try and generate more supply to meet demand. what you're always going to have is oversupply in certain property categories and certain little pockets of locations, and that is a momentary thing that you do need to take into consideration if you're looking to invest in those areas or in those property category types. But generally we do not have an oversupply issue, and I think this is important to acknowledge that when you're sort of looking to consider investing back home.
Yeah, okay. Just there's a couple of questions, and feel free to ask questions as you go, and we'll answer most of them at the end. But there's somebody called Bryce. Shout out to you, Bryce. Good to see you asking questions. So, what percentage of banks lending? I think we've touched on that. That they are lending up to 80% if you can convince them to do that, and that's great. And then in terms of assessing income for expats, they will definitely take into account your offshore income. So that's really good. They're still doing that. And Westpac we've got an in-house mortgage brokering service. If you need help on that, Wendy's great at doing that. But Westpac are pretty good. They're probably the best at working with Kiwi expats at the moment. And ANZ's not bad either. Yeah, so just have a chat to us if you wanted to get a mortgage back here. So in terms of, okay, so that's kind of interesting in terms of supply. What I'd like to talk to you about in terms of supply is that we've obviously got to build new stock as well. And at the moment, the banks have just been really, really cautious in terms of lending to developers. So they've got what they call at the moment no new to bank. So that's no new to bank. So any developer that's wanting to get a project off the ground, they will have zero chance of going to, if they're not known to a bank, if they go to a new bank that they're not known to, they'll have zero chance of getting that bank to fund their development. So all existing developers will have to work with their existing banks. And each bank has got a different appetite for development, and they've been super cautious. So for example, the BNZ, and this is only anecdotal, I can't tell you that this is a BNZ policy, but at the moment their view is that, gosh, you've got to, yep, you can make a margin off development lending, but there's a lot of work that goes into analyze that and goes into monitoring it. And we're better off putting our efforts into small to medium-sized business banking, where we can charge higher interest rates and more likely to get our money back in the door. So that's not helping the development community. And we do need development, but it's stymieing supply. So if we come back and think about the balance of demand and supply, what we've got is we've actually got a reasonable level of demand, and net immigration has not died at all, and we've got reasonably favourable finance conditions, albeit you've got to work hard to get the banks across the line. And then on the supply side, we don't have a rush of stock. So if you think about simple economics, demand still current for residential housing stock still exceeds supply. So that's and we like to start with that residential side of things because it underpins a lot of the rest of the the property market, and understand where we're at kind of bit. But let's move to commercial then. So commercial is less directly driven by net migration. So just throw it out to you, Lisa. At a broad level, where are we at with commercial property, and what's happening? Are prices diving there because usually it's commercial that gets hit first? What are you seeing, and what are we experiencing on that front?
Yeah, commercial's kind of it's kind of interesting now because, post sort of lockdown, we now have these sort of businesses that are considered to be stronger and businesses that are considered to be weaker. And of course that sort of, that governs sort of the tenant covenants. And so a lot of the commercial is now being viewed through those eyes, where prior to lockdown, we weren't looking specifically at the tenant type necessarily. We were looking just purely at the strength of the lease itself. So kind of an interesting dynamic that's emerging with commercial. Obviously, let's just talk about where there's weakness. We've got obviously weakness in the tourism and hospitality sector, so where we have accommodation. Retail is struggling. So while it sort of feels like you go into the malls here and there's definitely lots of people around, there's lots of activity. I was in one of the big malls at the weekend. I mean, it's humming, there's people around, but when we have a look at card sales, retail is definitely well down. And then there's sort of the office component to a lesser extent is affected, but demand remains really strong in the industrial sector. So bearing in mind that industrial sort of is our construction and manufacturing, and that makes up a fifth of our GDP. So, you know, that's always been strong and it remains strong now. I think what we're seeing is just a bigger weakness in some of those other areas that weren't there prior to lockdown. Consents are lower, so we've got less building going on with commercial, but we actually had unlike residential, a little bit more of oversupply in the commercial side of things going into lockdown. So the fact that those consents have slowed down is probably okay. It's not really going to have much impact in terms of what will happen with the commercial market. What we're seeing is lease extensions going on. So where leases are coming up for renewal, perhaps they're coming up this year or early next year, businesses are just looking to try and get extensions out of them for a little bit longer just to bridge the time of uncertainty. So where we might be expecting to see vacancies and understand what a pending vacancy rate might be, that's a little bit hard to see at the moment, and that's because these lease extensions are being granted. We do have consumer confidence rising though, which is really good. So it was obviously post lockdown quite low, and at levels which very similar to where we're at with the GFC. But now that consumer confidence is rising, so that's always a good sign. What the sentiment is. Higher quality properties with good tenant leases, they remain solid in terms of pricing. So where are the opportunities? Well, again, the opportunities are really in these sectors that are considered to be safe. So government sectors obviously is safe, but also areas that are growing, which is specifically IT and health. Auckland, again, considered really safe in terms of commercial opportunities. Not to say that there aren't other great areas to invest where the tenants are essential services, so they're tenants that are considered to be able to keep going through any sort of future wave of COVID should it return. And then so look, overall it's doing okay, but it's very much segment by segment, and I think that's the difference.
Okay, thanks Lisa, and apologies for my screen dropping. I hope you don't mark me down too much on the post-presentation assessment.
I thought I should be running this on my own for the rest of the evening.
Yeah. So it's got nothing to do with the amount of wine that I'm drinking. Okay, so we talked about the commercial. Well, I guess broadly about the commercial, but in terms of lack of supply or oversupply, you've talked about maybe some oversupply. But how does that? I mean, with commercial, it's a little bit different because you really need to talk about the specific areas of commercial. So we've got office, industry, and retail. Where have we seen the biggest oversupply of property? Is that in the office space or is it retail? Would you touch retail, especially given we've seen retail impacted pretty heavily during the lockdown, and in general, we've got the internet buying sensation. So we've got the retail side of it, the office and the industrial. Talk us through those three different areas.
Yeah, so what we did have an oversupply of coming into lockdown and was the accommodation sector. We had a lot of hotel construction pending, so I think that's going to be continue to struggle. So anything that's sort of tourism and accommodation led, that will struggle. So even in areas that are large tourism areas, Rotorua, Queenstown, our two sort of iconic areas for tourism, even industrial sort of sector, office sectors, they're going to struggle just because they've got strong links to tourism and accommodation. Retail, again, just generally is tricky, but then it's more retail that is probably at higher risk than, say, small strip retail. So again, it's location, again, it's size, and again, it's the tenants. So what if it's essential services? So we're talking, pharmacy, dairies, food, those things will continue to survive, and retail with those tenants in place, particularly if those leases have got good length to them, then retail with those tenants will be fine. Industrial just has a little bit more breathing room in terms of just generally as a sector, it's doing well. Logistics is just one area of industrial that is performing really well and became really evident during our COVID period, where we moved to a lot of e-commerce in terms of retailing, and so all the warehousing that sort of linked to the retailers was just that really came into its own. So look to be on the safe. If you were looking to go out and do commercial tomorrow, you've really got to think two things. In category, you're probably going to be safe with industrial. From a tenant perspective, you can look at some of the other sectors, but you just need to consider them in terms of, are they an essential service?
Yep.
What would happen to them should we go through another COVID period?
Yeah, of course. And I guess even if they are perceived to be essential service, you've still got to, I think, in my view, dig really deep on the tenants. So we've just got a property under contract for our next syndication offering, and they're in the meat industry, so they're producing small meats like sausages and salami. And even then, we're going to go in and get our accountants to do due diligence on their business to confirm that they're viable. Because I think in this environment, you'd want to do some pretty deep research to know that your tenants are going to be viable. If you're buying commercial, I'd really, really encourage to push really hard to be able to investigate the financials of the tenant, not just just some surface desktop research, but just get in and look at their financials, because you do not want to be buying a property with a tenant that could fall over in 6 months' time. So I think that's really, really, really important. So if we talk about maybe now, look, just to close all of that out, are prices going to crash? I can't see it. I don't think, now that we've sort of traveled through talking about those fundamentals of demand and the demand and supply drivers, I'm not sure that we're going to see a massive wholesale crash in the marketplace. Bearing in mind that, we've traveled collectively, Lisa and I have traveled through a couple of these recessions with property, watched them, we've experienced them. We started this business in 2007, in April 2007, and said, gosh, we know that the property market's going to come off the top. How hard can it be to start a business like that? And it got pretty ugly. But we watched the market really, really carefully through the GFC, and our conclusion was, hey, in fact, the first presentation that we did in London was in 2011, and said, really prices are going to start to rocket because there simply isn't enough supply of property. And I remember people kind of looking at me sideways going, really? You really think the prices are going to take off? And sure enough, they rebounded really, really strongly out of the GFC. So here we are again, and what we've got is demand has not completely fallen away, and we haven't got a massive oversupply. So I think we'll travel down this road for another 12, 18, 24 months where prices are meandering along. But what will happen is we'll have growing demand as the borders open again and population growth takes off, but we just won't have the supply because banks aren't willing to actively lend to developers. So I think we'll get this build up of demand like you have behind a dam. You've got a dam wall, and I think we'll see the build up of demand, and at some point that will need to be released. Let's talk about, Lisa, if we could, where would you buy? If you were going to go out and buy today, we've got Queenstown, which is a hot market, and I'm in love with Queenstown, and I've got a property there and like to go down there, and we've experienced some great capital growth. Is that dead? Where would you buy at the moment? So I guess, where would you buy, first of all, if you were searching for capital growth over the next 5 to 10 years?
Yeah, that's a big question. Well, firstly, just to go back to kind of where all these regions are at, and again, just back to what I said in the outset, is that we've got an increase in property values year on year, and we kind of talk about the country in roughly sort of 16 regions. So 11 out of those 16 regions have actually performed really well year on year. So we've got a number of areas across the country that are doing well, that are, you know, again, it comes back to what are your goals. If your goals are capital growth, then you're going to do something different to if your goals are yield. But assuming that you're buying for capital growth, there are a number of areas across the country that will help you achieve that. I think it's important though, particularly at times like this where we have some uncertainty, is that you need to look at those areas and understand them in terms of those fundamentals, population growth, and in particular jobs. So you know, and that would probably drive us back towards some of the biggest centres. So I think that's a good place to start. But look, I really just want to highlight the Waikato at the moment, because there has been a considerable amount of growth in the Waikato for a long period of time, and it's still continued. And interestingly enough, it is soaring in the commercial sector as well as the residential. So when you get these sort of two sectors, particularly a time like this, that sort of line up together, there's definitely something great going on. So that's just something to throw out there. It's only one area, but it is achieving good growth. There's a huge amount going on in the Waikato, not just in Hamilton Township, but some of the areas that are outside of Hamilton City. So that's definitely something to have a closer look at. Yeah, again, it has to, you know, putting the context of a post-COVID environment into this, you also need to have a look at, is there a reliable rental market? So wherever you are, once you've looked at your population growth and jobs, you need to also understand, well, is there still a reliable rental market? Maybe what was happening pre-COVID is changed, and you just need to make sure that you do kind of a good assessment on that. Look, there are some categories that I wouldn't be looking at, and they're definitely these areas of oversupply by category. So right now, the apartment market, particularly in Auckland and some of the other bigger centres, is that we have got stock that was in oversupply before we went into this, but we now have lost a lot of the rental market, some of that belonging to our foreign students. They can't come in, so you've sort of got to do a really good assessment on your rental market as well. And somebody just posted a question, sorry, I'm just reading this on the screen, because you're looking at new properties for sale in Christchurch. I see a trend of new builds resembling the UK with row houses, semi-detached, etc. Is this a trend that's happening everywhere? So these type of detached houses are there's a lot going on with that type of construction. Again, it's affordable. It's affordable for the developer to do it, so, and also affordable in terms of the market. So, but then what does happen with that is that we do have an oversupply of those as well. So they probably fit into that sort of apartment sort of slash townhouse market that you need to be a little bit careful of. So I'm not saying don't go there, but there are certain areas where you have got more supply relative to demand, and you do need to just be careful when you look at, particularly if your goals are capital growth.
Okay. Look, I think we might just jump into some of these questions and start answering them. So, like to know when non-residents buy and sell will drive the price up or down. I think that's what that's really saying is, thanks Ricky, is, you know, is there going to, first of all, will non-residents have an impact, and perhaps where will that be? It's all a bit slowed down at the moment. So first of all, non-residents can't buy existing residential stock, but there's nothing stopping them buying commercial. There's nothing stopping them buying off the plan. So yes, they have restricted what non-residents can buy or non-citizens can buy, but not to the extent that perhaps some people thought. And on top of that, Singaporeans can buy regardless. So you know, will they have an impact? No more than normal, I don't think. what are the views on tax changes that the government is thinking to pay for the COVID response? Okay, well, let's talk about what potentially they could do. They talked about a capital gains tax earlier in the year, and they backed away from that because I think they quickly realised that was probably a they're probably going to lose their job if they push too hard on that. Would they bring that back now? Possibly, possibly, and it's often a question I've had been asked since 2011. And would it impact prices? Not overly. It's a bummer. I don't want it. I don't necessarily agree with it. But if it happened, is it going to mean that property prices tank? I don't think so. So that's kind of my view on that. ANZ, somebody said that ANZ was a bit difficult last year. Yeah, I mean, banks are interesting, because you've got to know how to work banks. Banks have account managers, and then they also have credit controllers, or the credit department that isn't allowed to talk to the public. So the account manager's job is to be nice to you and then go and sell you to credit. And there really is a great degree of variation between a poor and average and a good account manager. And we spend a lot of time dealing with banks. So sometimes it can depend on who you get. Sometimes it can be simply the bank policy. And, it does vary week to week as well, because one week the bank is restricted in terms of the capital they've got to lend, and then the next week all of a sudden they've had a whole bunch of money roll back in and they've got to get back out in the marketplace, so they might relax credit criteria a little bit. Hi, it'd be great to get your view on the Queenstown market and where the best value region is to buy. I'm going to let Lisa answer that. Queenstown, again, maybe just revisit that one. I know I've kind of asked you that already, but maybe just revisit.
Sorry, no, I didn't speak to Queenstown. Sorry about that. Yeah, so the Queenstown market has, just in terms of sort of price variation, Queenstown has probably taken the biggest hit to date. And also the rental market has kind of had to sort of recalibrate, just because we had a lot of young and transient workers in there working in tourism, and of course that all stopped, so that they had to kind of exit properties, and now we're sort of going through a sort of a recalibration process with the rental market, which is starting to re-stabilize. What is great for Queenstown, and I think a little bit unexpected, was that all these people that are there don't want to leave. So we've still got people that are trying to sort of see it out. They want to stay. They've still got places that they want to, they have to live somewhere. So that's the good thing for the property market. What has been interesting in terms of house prices to date is that there has been a little bit of retrenching, but not a whole lot. And that retrenching has mostly taken place in properties that might be more conducive to short-term rental, Airbnb, young flats where you've got sort of your young sort of workers in hospitality and tourism would be likely to live in. Once we go out into the suburbs, we go out to for those of you that know Queenstown well, Jacks Point, Lake Hayes Estate, Shotover Country, where we're out in family-oriented areas, that the pricing in those areas is for now staying pretty, pretty robust. So yeah, it's kind of interesting. Early days, because a lot has happened in a short space of time. We are actively working in the area, because we do have client briefs and clients that are actively looking to acquire property in Queenstown. So we feel pretty close to the market there. And what I'm looking at in terms of sales that have happened post COVID or post our lockdown, they've all been pretty solid. But again, it's those family homes, that 3-4 bedroom home, they're the ones that are keeping values strong. Anything that's sort of more flat related units closer to town, you need to have a closer look at those. They may not be the answer right now.
Yeah, okay, got it, thank you. Residential house prices from Benson. Residential house prices continue to increase year on year in Auckland. Is this likely to be an ongoing trend where prices continue to rise even after COVID, looking into the next 2 to 3 years? Look, I'm biased, so I'm going to say, of course, prices are going to kind of rocket up. But seriously, 60% of population growth comes to Auckland, historically speaking. So we're likely to see that demand increase in Auckland. So again, it comes back to demand and supply. And what drives prices increasing is when demand exceeds supply. So I think once the borders open, we're going to continue to see 60% of that growth come to Auckland. That means demand for more housing. And if we go into say post 12 months, or if we go into month 13, and there has been a real cap on buying and supply more specifically, then I think we are likely to see prices start to take off again. It's inevitable. And the more that we kind of study the property market, the more you tend to zoom back and look at it and try and get perspective. We're always trying to get perspective on where we're at. And it's often, I think that the trap is it's very easy to get caught up in the next month and the next quarterly announcement, next GDP announcement, and where we're going to be at. But property is a longer term play, and if you're in it for the long term, I think it's about looking at where we're likely to be in the next 5-10 years time. Now, that's not applicable to everybody. Some people are in it for the yield right now, and they want to be extracting yield. And so, that's relevant as well. But in terms of where will prices go in the next 3 to 5 years, it's hard to see that prices in Auckland won't go up. Prices were starting to track upwards quite quickly just before lockdown, and then that got shut down. So I think there'll be some pent-up demand. Are there...
that New Zealand is considered a really attractive place to live. So and that's probably a little bit relevant to Queenstown as well. That partly what is sort of continuing to bolster the Queenstown market is that there are people that still really want to come and live here and are buying here even though they can't come right now. And Auckland is no different. New Zealand in general is an attractive place to live, and as we get more things happen globally that create uncertainty and particularly at a time like this when New Zealand is faring very well in the face of COVID compared to what's happening globally, we remain a really attractive place to be, whether that's Kiwis to return home or other people to come.
Yeah, definitely. So are there particular areas of the country that are undersupplied in terms of residential rental properties? I imagine there are still the person asking the question, I imagine there are quite a few viewers in my position who are looking to buy an investment property in New Zealand at the moment. That's great if you're looking to buy, then you need to talk to us and we can absolutely help you with that, and we can do that for you so that you can concentrate on your London job or English job, and we'll make that happen for you. Where would we buy? Well, that's kind of part of the science of what we do, is trying to think really carefully about where to buy, and it's a term that depends on your goals. But if it's capital growth, you want to be where the most people are. You want to be where the prices are most likely to go up. So or probably more to the point, where are most people likely to flow to? So, for example, 5 years ago or even more, we said, look, I think we hadn't yet bought in Hamilton, but we decided that Hamilton was going to become a critical cousin to Auckland, because Auckland prices were going to keep going up, and therefore people would look to relocate to buy where it's more affordable and think about lifestyle. And sure enough, Hamilton's gone nuts, and we're buying in Hamilton all the time. And as soon as we came out of lockdown, it was straight back into multi-offer scenario. So we've got a couple of properties under contract a couple of weeks ago, and they were both multi-offer scenarios, and we managed to win those. But that demand hasn't slowed down. So I think, like Hamilton's a place that we like. There's areas that we're more careful about, like Wellington. Christchurch, there tends to be an oversupply, so we're a little bit cautious there. And it really just comes back to the science of it and understanding where the population is and just running those numbers. So in one sense, it's not really crystal ball gazing. It's just a lot of good research and that Lisa leads in understanding where to buy. When you mentioned oversupply of apartments, this is from Nick, is there an oversupply across the board, or more for particular price bands, e.g. under 1 mil, I've typically seen apartment economics behave very differently in different price brackets. Has this changed somewhat? Have you got any comments on that, Lisa? That's quite a specific.
Yeah, that's a good point, Nick. Yeah, look, to be fair, there is, compositional sort of differences, and I wouldn't say it's in the under 1 mil, but it's probably more targeted towards the how many bedrooms, and that obviously would come under something that's around sort of 700, unless that's if you're sort of talking about Auckland. So where you've got sort of small studio apartments or one beddy apartments, these are huge sort of supply of those, so you would need to be fairly careful. But then once you get up into looking at things like 3-beddy apartments, you've also got to start to look at the who your market is for that. So it's just about being you do need to look at this quite carefully, and it's a little bit hard to say without sort of looking at an area closely and doing an assessment on it. But if there isn't the market for a big 3-bedroom apartment isn't there like there is the market for a small 1-bed, 2-bed apartment. So you do need to look at this quite carefully. But yes, I acknowledge that there is some compositional differences, definitely, and of course different locations. But Auckland is got a lot of apartment supply, and of course because at the moment these students can't come in, so that's that's a real factor.
Yeah. Okay. Are Aussies able to buy residential properties in New Zealand? Absolutely. So there's no restriction on that because of the economic agreement that we've got. That's no issue whatsoever. So it's basically Australia and Singapore that there is no impact. And so we've bought for Aussies quite regularly, expat Aussies, and there's some good tax reasons for doing that as well, but that does depend on when you plan to return to Australia, and there's some quite specific capital gains tax in Australia that need to be taken into account. So no, absolutely. Another question: can you please talk to the outlook of the Auckland residential market for owner-occupied for expats planning on moving back in the next 12 to 18 months? Lisa, do you want to answer that?
Yeah, so the residential market, whether you're looking for investment or whether it's owner occupied, is really one of the same. I think what's happening with Auckland at the moment is it the fastest growing city in the country right now. If we go back to those sort of comparison of May this year to May last year, what's the growth been in the 12 months in between? Well, Auckland is not top of the list. There are other areas that have achieved a lot more growth than Auckland in that 12-month period. But I think what we need to understand about these different areas is not get sort of caught up in the sort of short-term metrics. I think we need to have a look and go, what drives long-term growth? And I know that you're not talking specifically about investment, but it's what is going to perform long-term in terms of location. And we need to look at all those things that, again, population, jobs. Auckland is the economic engine of the country. It is always going to perform well long-term. So I think that if you are looking and considering Auckland, whether it be for residential or somewhere to live, then that's obviously a really sound consideration.
Yeah.
There is a lot of expats that have come home already that are actively buying in the market. We are seeing that. We're seeing that flow through already. So currently with our quarantine facilities, there's 4,500 Kiwis coming through sitting in quarantine at the moment. It's been like that for the last 4 or 5 weeks, and we're expecting that to continue for some weeks to come, and with this capacity at the moment for up to 6,000, they're trying to build on that. So that gives you an understanding of the number of Kiwis, because it is only Kiwis and permanent residents that can come back in. That just gives you an idea of the flow, that is the inflow, and those people are coming out translated to buyers in the market for homes. So definitely seeing that already. A lot of it is in Auckland, but there'll be a lot of other areas around the country also, bearing in mind that people are going to where there is potential employment.
Yeah. With net migration so important for housing demand from Fiona, when do you think borders might open? Um, your guess is good as
Million
mine.
dollar question, Fiona.
Yeah.
Yeah, yeah,
So
we
Australia,
don't know.
no, we don't know. I mean, Australia, we thought we were going to be able to open it up, and we know that Auckland Airport, and we know, we're talking to people that are petitioning government for it, but there's other factors at play. We've got we've got an election coming up. Australia, arguably doesn't really care what happens to New Zealand. They want to keep their own people happy, and that government over there doesn't necessarily like the New Zealand government. But that's just that's just my opinion. So we don't know. New Zealanders are free to now travel offshore to some European countries, but then how long will it take them to get back in? Well, look, borders aren't going to be shut forever, and there will be pressure to open the borders because it has a massive, massive economic impact. So there's only so long that you can keep them shut, and at some point there probably needs to be pragmatism that rules. But that's not today, and it's probably not any time in July. But it'll happen. It'll happen, right? But at the moment, we've talked about net migration and where that's at. What parts of the country do you think will be strong from a yield perspective in the near term? Lisa, any thoughts on that? So what parts? Yeah.
Yeah, so there's several areas, but one of the fastest growing areas in terms of growth and also from a yield perspective is Southland. So and you're asking from a yield perspective, one of those areas would be Southland. For those who don't know your country geography well, that's Invercargill and some of the areas around that. There is good opportunities from a yield perspective in there. So can't make any other comment about whether I think that is a good place to invest or not. But your question is from a strong yield perspective, I definitely would have a look at Southland.
Yeah, and I suppose yield is interesting because you've got residential yield and you've got commercial yield. So from a residential point of view, that absolutely applies. From a commercial perspective, yields or cap rates are lowest in Auckland, and they've got ridiculously low pre-COVID and probably haven't changed that much. And then as you move out towards different areas, they get better and better until you get to Queenstown, and then they're probably more like Auckland yields. But it depends on what you're trying to achieve. And so when people ask me where should I buy, my question is always, well, what are your goals? What are you trying to achieve? And if you're a professional and you're currently working and you've got good 10, 20, 30 years ahead of you, you're simply trying to grow your wealth, well, that means that you're really chasing capital growth. And that would mean that where you buy and what you buy might be different to if you said to me, well, I'm considering retirement and I'm really just wanting to get myself set up so that I've got some great yielding investments. Well, that would be very different. So, and that's where, Erskine and Owen, our passion is intelligent property and helping people achieve their investment goals and their financial goals. And I guess that's my personal passion as an authorised financial advisor. I still do property investment planning sessions, and it's that enjoyment of sitting across from people and saying, well, what are your goals? What are you trying to achieve? And that's what we bring to this, I think. And so, we can talk about the property market till the cows come home, but ultimately, what is it that you're trying to achieve right at the moment? Is it that you're trying to get your capital that you've got working harder and smarter and creating wealth and enough wealth to be able to live without working? And so that means passive income. Or is it that you've got some wealth and you're trying to derive that passive income? So, from a passive income point of view, we've got our syndication offerings, which generate yield. So we did a Watties distribution warehouse in Hastings that we bought for 30 million, and we syndicated that where we grouped buyers together to buy that, and that has an 8% yield. So that's a really, really attractive yield from my perspective, in my opinion, and that's been performing really well, and it was a great investment for these times. So for people that are happy to get yield, then that's great. Then we've got those people that are trying to get capital growth and build their wealth, and would say, well, mate, and they might have a deposit. So, hey, commercial property might not be the best option right now. Let's get into residential property and grow your wealth. And so it really does come down to what you're trying to achieve. So that's the long answer. What do you expect to happen with the second home market, the likes of the Coromandel, for example? So I guess what you're really saying is, what about the holiday market, holiday properties, whether it be Omaha or north of Auckland or Piha or wherever? What are your thoughts on that, Lisa?
Yeah, the second, what you call sort of second home market, I guess what you mean is holiday home market. As always, these kind of areas are quite interesting at times like this, and particularly post-COVID. We've got a lot of people who've sort of being in lockdown's really given them an opportunity to kind of rethink lifestyle and lifestyle choices. And so there's kind of a bit of activity in these areas. It's also, the Coromandel is a big retirement area also. So we've got sort of demand from that. We'll have demand from those people wanting to consider more lifestyle options and living sort of some of these areas permanently, getting out of the city. But then we also have, some people that will look at selling just because they have, been affected through COVID and needing to liquidate those holiday homes. So, look, I think it's early days with that. If we have a look back at the GFC and look at some of these same areas and what happened then, it was a similar pattern, and it happened over quite a long period of time. So, these are areas that, if you're thinking, lifestyle, these are, areas that you're wanting to create memories in, have holidays, you need to look at them and through eyes sort of separate to pure investment terms.
Yeah, okay. And so I think you might have answered the next question, which is I'm out walking the dog in Papamoa. So there you go, somebody locally listening in, thinking of selling and moving to the country. What's the demand? I think you've answered that, and so we're going to say done to that. I'm just actually seeing that there's probably another little chat room where there might be some other questions. Somebody has said, what is the current market on buy and sell from foreigners like the non-resident Chinese? Will that drive prices up and down? I think we've answered that. Another question from Nick. Assuming residential prices remain relatively stationary with the drop in demand balancing the increase in supply, do you think industrial properties will increase in value as a safer investment alternative? I think industrial is going to be very, very strong. And I think that, it's still industry specific, but I do think that that's going to be a safe haven. People will revert to that, or retreat probably is the better word to that. So, but again, it does depend on the tenant. So I really like industrial. You want to have enough spend.
Just on that, it's our, industrial is supporting our goods producing sector. So our goods producing sector is a fifth of our economy. So the industrial category has a big part to play in that, and I think that's why we can sort of feel fairly confident about the the future performance of industrial, particularly at times like this.
Yeah. Okay, that's really good. Look, so I think we've answered most of the questions, or all of the questions, and I think this was supposed to run for 1:40. So I used to finish this early so that we could get early access to the New Zealand beers and pies, but unfortunately, that's not possible tonight. And all I can offer you is me not drinking my New Zealand Pinot, because I've already drunk it all. And so look, thanks for all those that have dialed in to listen. Just to wrap up, Erskine and Owen, as I've sort of alluded to, we're passionate about the property investment sector, and we started out simply buying properties on behalf of Kiwi expats and busy professionals, and that's grown over the last 13 years. And Lisa and I started this with a real passion to help people buy quality property after seeing people buy some get caught up in some really bad property investment offerings. And so for us, it's about taking people on that journey, understanding their goals, and then helping our clients achieve those goals, whether it's through direct property investment or mortgages or property management. So firm, Point Property Management, that we own as well, does that right through to syndication. So we can do all of that. But, you know, we've been doing this for 13 years, and we are really good at property, and I don't mind saying that. And we've done hundreds and hundreds of transactions, and we started doing this when I had brown hair, and now it's turned grey, and I've got 3 children, and we're still equally passionate about property. But I think what we're mostly passionate about is seeing our clients achieve their financial goals. So that's what really gets us out of bed. And again, whether it's achieving the yield that they're after with the equity that they've got, or building the equity so that they can achieve a passive goal, and it really, really is doable. So, hey, get into contact with us. We're at Erskine and Owen, and we're really easy to find, www.erskineowen.co.nz, and get in touch, and we'd love to hear from you. And if you have got any questions, any other questions, just fire them through. So thanks very much, everybody, and we're going to dial out from here. So thank you.
Thanks, everybody. Take care.